So in this video, I want to walk us through the preparation of the direct approach. Remember, the direct approach only affects the operating activity section. Investing and financing are prepared in exactly the same fashion, whether you're using the indirect or the direct method. What we're doing in the direct method is, instead of starting with net income and reconciling to cash basis net income, we are actually determining the cash we received from different sources, the cash we paid out from different sources. And we're going to do this by taking into consideration the income statement line items adjusted by changes in current assets and current liabilities that relate to them. So, for example, cash received from customers is going to be a function of your sales revenue adjusted by the change in accounts receivable. So, my formula here pulls from sales revenue of $200,000, but we know that accounts receivable increased, which means some of that sales revenue wasn't collected, so we subtract the increase in accounts receivable. And so we come up with cash received from customers of $191,000. Cash paid to suppliers is going to be a function of cost of goods sold. Remember, a change in inventory impacts cost of goods sold, so that will be taken into consideration. Plus, we need to take into consideration a change in accounts payable, because that would determine how much of this cost of goods sold or purchase of inventory would have actually been paid out in cash. So my formula, if you follow the formula through, it is taking cost of goods sold of 80. We look at the change in inventory. Inventory went down, which means part of that $80,000 in cost of goods sold is going to be the $20,000 of inventory we used from previous years. So we will subtract that $20,000. So now we're down to 60. Then we look at accounts payable, and accounts payable went down by $5,000. So that increase or decrease in accounts payable means additional $5,000 that was paid in cash. And so we are up to $65,000. Now, clearly what we're doing here is making an assumption that pretty much everything in accounts payable relates to payables to suppliers. That may not necessarily be true, but from a materiality perspective, it's probably an okay assumption. Then cash paid to employees will be a function of salary and wage expense, and then any payables we have related to salary and wage. In our example, we have salary expense of $39,000, but if you look at the balance sheet, there are no payables, which means or accruals, which means that $39,000 represents also what was paid out. Cash paid for interest is going to be a function of interest expense on the income statement plus changes in interest payable. We can see there is $3,000 in interest expense, no interest payable, which tells us that the expense and the cash payment are the same. Cash paid for insurance. Again, we'll start with insurance expense on the income statement of $1,000. But you notice on the balance sheet we have prepaid insurance. Prepaid insurance increased by $2,000. That means in addition to the $1,000 in insurance expense, we paid out $2,000 additionally associated with insurance. So we have cash paid for insurance of $3,000. And then in this example, the last item we have is income tax expense. Again, we'll start with the income tax expense. Then we'll need to look for changes in income tax payable or deferred income taxes. If we go to our financials, we'll see there is $18,600 in income tax expense. There is an income tax payable that increased by $2,600. That would have reduced the amount of cash we paid. And there are no deferred income taxes. So we have cash paid for taxes of $16,000. If we sum up all our payments, that's payments of $126,000. We subtract that from our cash receipts. That gives us cash flow from operating activities of $65,000, which is exactly what we got in our indirect method. Again, you should not get a different cash flow from operating activities. It will merely be presented in a different way.